Welcome back to Unmarked File. Today, we are analyzing a phenomenon that's quietly reshaping global financial markets, while most media coverage focuses on headlines rather than the mathematical precision of capital flows. What you're about to hear isn't political commentary or speculation. This is documented market behavior, measurable capital migration, and the systematic repricing of American assets by international investors. The story begins with gold trading at $5,120 per ounce as of January 29, 2026. But the real story isn't the price itself, it's what drove that price, who's buying, and why traditional market relationships are breaking down. By the end of this analysis, you'll understand why international money managers are implementing the Sell America trade, and what this means for the global monetary system. On January 20th, 2026, the new administration's foreign policy direction became clear through international statements and policy positions that would reshape global risk assessments. Within 6 trading days, measurable capital flows began moving out of dollar-denominated assets and into alternative stores of value. This wasn't gradual portfolio adjustment. This was systematic capital reallocation driven by quantifiable risk assessment changes across international financial institutions. The sequence of policy announcements created what market analysts describe as a confidence inflection point, where international capital began reassessing the risk-reward profile of American asset exposure. Comments regarding Greenland, policy statements about Venezuela, and discussions about Middle East intervention were interpreted by global markets not as diplomatic posturing, but as indicators of policy unpredictability requiring immediate portfolio adjustments. Professional money managers operate under fiduciary responsibility requirements that mandate risk assessment based on measurable factors rather than political preferences. When policy statements suggest potential military or economic interventions, portfolio managers must calculate probability of outcomes and adjust allocations accordingly. The mathematics are straightforward. If policy unpredictability increases, exposure to assets dependent on that framework must be reduced. International institutional investors began implementing systematic selling programs across American equity markets, treasury securities, and dollar-denominated corporate bonds. These weren't panic sales or emotional responses. These were calculated portfolio adjustments based on risk management protocols developed over decades of managing money through geopolitical transitions. The Federal Reserve's independence became subject to public discussion in ways that alarmed international central banks and sovereign wealth funds. Public statements suggesting monetary policy should align more closely with executive branch economic priorities created uncertainty about the Fed's ability to maintain price stability independent of political considerations. Central bank governors from major economies began private communications expressing concern about Federal Reserve independence. The European Central Bank, Bank of Japan, Swiss National Bank, and Bank of England had built monetary frameworks assuming Fed independence as fundamental constant in global financial architecture. Statements suggesting this independence might be compromised required immediate reassessment of dollar-based reserve strategies. Currency markets reflected institutional concern through systematic dollar weakness beginning January 22nd. The dollar index declined from 106.3 to 102.7 in 5 trading sessions, representing the fastest sustained decline since 2008. Unlike previous dollar weakness reflecting domestic economic conditions, this decline was driven by foreign institutional selling rather than domestic factors. European pension funds managing over $3.2 trillion began reducing dollar allocation from historical 35% to target levels of 25%-28%. This adjustment represents approximately $224 billion in systematic selling pressure as institutions rebalance portfolios over coming quarters. Asian sovereign wealth funds controlling combined assets exceeding $8 trillion implemented similar dollar reduction strategies. Singapore's GIC, Norway's government pension fund Global, and China Investment Corporation began coordinated diversification away from dollar assets toward geopolitically neutral alternatives. Weekly Treasury International capital flows showed net foreign selling of $127 billion in the week, ending January 24th, the largest weekly outflow since record-keeping began in 1977. Japanese institutions reduced Treasury positions by $43 billion in January alone. This wasn't yield-chasing behavior, but systematic risk reduction driven by policy predictability uncertainty. The gold market became primary beneficiary of systematic dollar selling as international institutions sought alternatives offering store value characteristics and insulation from American policy uncertainty. Unlike previous gold rallies driven by inflation fears, this rally reflected specific geopolitical risk premium accumulation by sophisticated institutional investors. Central bank gold purchasing accelerated to unprecedented monthly averages of 60 tons compared to pre-2022 averages of 17 tons monthly. Goldman Sachs analysis indicates this represents permanent portfolio rebalancing rather than temporary market timing. suggesting sustained demand support, regardless of short-term price fluctuations. The composition of gold buying reveals institutional nature of current demand. Exchange-traded fund inflows represented only 23% of total investment demand during January 2026. The remaining 77% came from institutional sources, including pension funds, sovereign wealth funds, insurance companies, and family offices implementing systematic diversification strategies. Professional portfolio managers described allocation changes as responses to policy tail risk, low probability but high impact events that traditional portfolio theory struggles to address. Military interventions, trade war escalations, and Federal Reserve independence questions represent potential outcomes generating significant losses in traditional American asset portfolios. European institutional investors proved particularly sensitive to policy statements suggesting potential military interventions, given recent experience with Russia-Ukraine conflict, its impact on energy security and economic stability. Comments about potential actions triggered immediate risk reassessment protocols, mandating portfolio adjustments regardless of actual military action probability. Swiss private banks, managing approximately $2.8 trillion, reported unprecedented demand from clients for gold allocation increases and dollar exposure reduction. These institutions operate under strict fiduciary standards, requiring portfolio positioning based on risk assessment rather than political opinions. The Casa America trade terminology emerged from internal research notes distributed by major international banks describing coordinated dollar reduction strategies across multiple asset classes. This was not organized market manipulation, but simultaneous recognition across independent institutions that American policy unpredictability required portfolio adjustment. Morgan Stanley's international clients reduced American equity exposure by average 18% during January 2026. Credit Suisse reported similar patterns among European institutional clients. Deutsche Bank's asset management division implemented systematic dollar reduction across multiple fund families based on risk committee recommendations. These portfolio adjustments created self-reinforcing cycles where dollar selling pressure begot additional dollar weakness, triggering further risk assessment downgrades mandating additional selling. Unlike panic-driven moves that typically reverse quickly, systematic institutional adjustments persist until underlying risk factors resolve. The Federal Reserve faced unprecedented situation where traditional monetary policy tools proved inadequate for addressing capital flight driven by policy uncertainty rather than economic fundamentals. Interest rate adjustments could not address concerns about Fed independence or geopolitical policy unpredictability. Treasury yield curve reflected uncertainty through anomalous behavior where traditional relationships broke down. Typically, geopolitical uncertainty drives flight to quality Treasury buying, reducing yields and strengthening dollars. However, concerns about Fed independence created opposite effect where geopolitical tension triggered Treasury selling and dollar weakness. 10-year Treasury yields increased from 4.23% to 4.67% during period when traditional analysis would predict decreases due to safe haven demand. This inverted relationship reflected international investors' assessment that policy uncertainty outweighed safe haven considerations in portfolio decisions. Corporate bond markets experienced similar disruptions, as international investors reduced American corporate credit exposure regardless of company fundamentals. Investment-grade spreads widened from 142 to 218 basis points over treasuries as foreign institutional selling overwhelmed domestic demand. The foreign exchange implications extended beyond simple dollar weakness to fundamental questions about reserve currency status and international trade settlement mechanisms. Countries began exploring alternative payment systems and currency arrangements, reducing dependence on dollar-denominated transactions. Russia and China accelerated alternative payment system development by passing dollar-based international banking networks. European Union officials privately discussed enhanced euro-denominated trade settlement mechanisms, reducing transaction exposure to American policy uncertainty. Middle Eastern oil producers began accepting payment in alternative currencies for certain transactions. While these represented small percentages of total oil trade, they established precedents that could expand if dollar confidence continued declining. Central bank gold storage networks faced capacity constraints as institutions accelerated physical metal acquisition rather than relying on gold-backed financial instruments. Secure storage facilities in Switzerland, London, and traditional banking centers reported unprecedented demand for vault space and custodial services. The insurance industry began reassessing coverage for political risk and currency volatility as traditional models proved inadequate for systematic institutional portfolio adjustments occurring across multiple markets simultaneously. Political risk insurance premiums increased substantially for American multinational operations in regions mentioned in policy statements. International law firms specializing in sovereign wealth fund governance reported increased demand for legal frameworks protecting portfolio decisions based on risk assessment from potential political pressure or retaliation. Institutional investors sought legal protection for fiduciary, duty-driven investment decisions that might be interpreted as politically motivated. State government pension funds managing over $4.1 trillion faced difficult decisions about portfolio adjustments, balancing fiduciary responsibilities with potential political considerations, about reducing American asset exposure during policy uncertainty periods. California. Public Employees Retirement System implemented systematic risk assessment protocols, evaluating policy uncertainty impacts independently of political considerations. International trade relationships experienced strain as policy statements created uncertainty about future economic partnerships and commercial arrangements. Business leaders reported difficulty planning long-term investments and commercial relationships when policy direction remained unclear or suggested potential conflicts. The academic economics community initiated research examining how policy communication patterns affected international capital flows and whether alternative communication strategies could maintain strategic flexibility while minimizing economic disruption through capital flight and currency instability. Nobel Prize-winning economists published research examining relationships between policy uncertainty and international investment flows, focusing on mathematical models, quantifying how geopolitical risk assessment translated into measurable portfolio adjustments across institutional investment management. International business organizations, including World Economic Forum and International Chamber of Commerce, began developing risk assessment frameworks helping member companies navigate policy uncertainty while maintaining international commercial relationships and investment strategies. The transformation represented more than typical market volatility or cyclical economic adjustment. This reflected systematic reassessment of fundamental assumptions about American policy predictability that had anchored international portfolio allocation strategies for decades following World War II. International institutions had built investment frameworks assuming American policy continuity and Federal Reserve independence as foundational constants enabling long-term strategic planning. When these assumptions faced questioning, portfolio adjustment became mathematically mandatory regardless of political preferences. The gold market's role evolved from alternative investment to core portfolio component, as institutional investors recognized traditional diversification strategies proved inadequate for managing policy uncertainty risk. Gold's correlation with American assets approached zero during policy uncertainty periods, providing genuine portfolio protection traditional alternatives could not match. Professional portfolio managers described allocation increases to gold as insurance rather than speculation, reflecting institutional recognition that policy uncertainty represented new category of systematic risk, requiring specific portfolio protection mechanisms. The international monetary system faced stress testing revealing vulnerabilities in dollar-centric frameworks that seemed stable during policy predictability periods. When policy uncertainty increased, system dependence on confidence in American institutions became structural weakness rather than strength source. Central bank cooperation mechanisms developed since Bretton Woods required adaptation to address capital flow volatility driven by policy uncertainty rather than economic fundamentals. Traditional monetary policy coordination proved inadequate for managing confidence-driven capital flights operating independently of domestic economic conditions. The story we've explored reveals how policy communication patterns trigger systematic capital flows operating with mathematical precision rather than emotional reaction. What we're witnessing represents institutional risk management responding to measurable uncertainty rather than political positioning. The gold market's ascent to $5,120 reflects professional investors' recognition that traditional portfolio diversification strategies require supplementation with assets providing genuine independence from policy uncertainty. This isn't speculation. This is institutional capital seeking mathematical portfolio protection. The Sell America trade describes documented capital flows responding to risk assessment rather than political sentiment. When policy uncertainty increases, institutional fiduciary responsibility mandates portfolio adjustments regardless of political preferences or future predictions. What makes this period unique is speed and coordination of institutional response to policy uncertainty signals. Modern portfolio management emphasizes rapid systematic adjustment to changing risk parameters, rather than gradual adaptation characterizing previous eras. If you found this analysis valuable, please subscribe to Unmarked File and enable notifications. We track these structural economic shifts as they develop, providing analysis focusing on measurable market behavior rather than political commentary. Next week, we'll examine how central bank gold purchasing patterns have evolved from traditional reserve management to systematic dollar alternative strategies, and what this reveals about international monetary system structural vulnerabilities. These represent systematic changes in how international capital assesses and responds to policy uncertainty. Capital flow mathematics don't reflect political opinions. They reflect professional risk assessment and fiduciary responsibility requirements. Thanks for watching Unmarked File. Remember that the most important market moves often happen quietly, driven by systematic institutional behavior rather than dramatic headlines.